Hi, I'm Saima, an experienced management consultant. I've spent last 12 years in large organizations providing advisory and consulting services to business clients within the financial services, capital advisory, sports media, and marketing and advertising sectors. The financial models being offered at Fin Analytics Lab provide businesses, investors, and financial professionals to analyze performance, forecast future scenarios, and make data driven decisions. When lenders evaluate loan application, they don't just look at current financials. They model various scenarios to assess risk, repayment ability, and long-term sustainability. So in this tutorial, we explore how lenders use scenario modeling to make smart, informed decisions. Lenders modeling scenarios are what-if financial projections used to test a borrower's ability to meet debt obligations under different conditions. So these models allow banks and credit institutions to stress test deals and anticipate risks. Why do lenders model scenarios? Because real life rarely goes exactly as planned. So they use multiple scenarios to understand the financial health of a borrower across best case, worst case, and most likely situation. Key reasons for performing lender scenarios modeling is credit risk management, interest coverage analysis, covenant compliance, and cash flow sufficiency. So let's break down the common types of scenarios lenders model. Number one is base case. So this is basically the borrower's most realistic expectations. Number two is the downside case, which includes adverse assumptions like revenue drops or higher interest rates. Number three is severe downside or stress case. So these models are extreme but plausible events like economic downturns, supply chain disruptions, or regulatory changes impact these. Then the upside case for completeness. This shows optimistic outcomes such as better than expected revenue. The key inputs in scenario models include revenue projections, operating costs, capital expenditure, debt terms, interest rate assumptions, and working capital needs. So adjusting these inputs under different scenarios help forecast outcomes like cash flow, EBITDA, and leverage ratios. So normally lenders track critical outputs to assess a borrower's financial resilience. These include debt service coverage ratio, which is also called DSCR, interest coverage ratio, which is also called as ICR, loan to value, which is called LTV, and then the cash flow available for debt service. So this is also abbreviated as CFADS. And then the covenant compliance matrix. So if these metrics fall below acceptable thresholds, it may indicate repayment risk. Stress testing allows lenders to simulate how changes in interest rates, revenue drops, or cost inflation affect the borrower's ability to meet covenants. For example, a DSCR falling below 1.2 may trigger a default or renegotiation clause. So let's understand the concepts with a real-world example. We have selected a mid-sized manufacturing firm taking a 10 million loan. So the base case assumes 10% annual revenue growth. The downside case models only 2% growth with higher raw material costs. So the lenders find that the While the base case meets all covenants, the downside case puts DSCR dangerously close to the default threshold, and this triggers a conversation about high equity contribution or tighter monitoring. Lenders often work closely with borrowers to refine assumptions, test refinancing options, and structure repayment schedules that reduce risk. Iteration and transparency are key to getting financial models approved. So, in a nutshell, lenders use scenario modeling to understand borrower risk profiles, test covenant strength, plan for downside protection, and ensure debt serviceability. Best practices they use are making realistic assumptions, including downside stress tests, and focus on cash flow and covenants matrix. And now we will dig a little bit deeper in terms of understanding how lenders assess borrowers' financial position on an ongoing basis. So lenders continuously assess a borrower's financial position to ensure they can repay the loan and to mitigate any potential risks. So they evaluate businesses on an ongoing basis by regularly reviewing their financial statement analysis, cash flow monitoring, credit score and payment history, collateral and asset valuation, and then the last, which is covenant compliance for business loans. Obviously, they also review industry and market risk assessment, ongoing communication and reporting, and So in terms of reviewing the borrower's financial statements, lenders examine balance sheets, income statements, and cash flow statements to track profitability, liquidity, and solvency. The key ratios they monitor are debt to equity ratio, that measures basically leverage risk, current ratio and quick ratio, assess short-term liquidity, debt service coverage ratio, which is also called DSCR, checks if cash flow covers debt payments. And they also monitor trend analysis as well in terms of comparing past and present performance to spot financial deterioration. In terms of cash flow monitoring, so lenders review operating cash flow to ensure the business generate enough cash to meet obligations. They also review burn rate and working capital to track how quickly cash is used and whether the business can cover short-term liabilities. And they also study seasonal variations, any adjustments for businesses with cyclical revenue. And the lenders also review credit score and payment history. So like any drops in score triggers lenders reviews. Late and missed payments, so red flags. These are red flags that may lead to stricter terms or loan recall. Lenders also review collateral and asset valuation modeling as well. So they check if pledged collateral in the form of property inventory, so if that maintains sufficient value. They also consider depreciation and liquidation value to ensure assets can cover the loan if the borrower defaults. And for business loans, they also review covenant compliance. So in terms of financial covenants, the borrowers must meet agreed terms such as minimum EBITDA or net profit, maximum debt to income ratio, capital expenditure limits, and if there are any breach consequences. So violations may lead to renegotiation, higher interest, or loan recall. In parallel, lenders also track industry trends. For example, retail downturns, tech booms. They also study macroeconomic factors such as interest rate hikes, inflation, or supply chain disruptions that may trigger reassessment. Some lenders require quarterly or annual financial reports, site visits in terms of larger loans. So they go and check physically on operation and inventory. They also monitor bank accounts, so they may track deposit withdrawal patterns. So how borrowers can make sure that they stay in good standing? So they need to maintain accurate, up-to-date financial reports, avoid sudden debt increases without revenue growth, and communicate proactively if facing financial stress. So, how to improve your business's credit worthiness for lenders? In order to secure better loan terms, lower interest rates, and higher approval chances, businesses must proactively strengthen their financial profile. Here's how. Establish business credit. So open your accounts in your business name, trade credit with suppliers, business credit cards, use services like Experian, Equifax, businesses to build a credit history. Pay bills on time. So late payments hurt your score. Set up reminders or auto pay. Keep credit utilization low. So try to aim to use less than 30% of your credit limit on business cards or lines of credit. Another factor to consider is to strengthen financial statements and ratios. So try to reduce unnecessary expenses, renegotiate supplier contracts, and increase margins. Improve liquidity. Try to maintain a current ratio above 1.5 to show short-term stability. Try to avoid excessive borrowing. Aim for less than 2 to 1, which basically varies by industry. And then increase cash reserves. So lenders prefer businesses with 3 to 6 months of operating cash as a buffer. Also try to demonstrate consistent revenue and cash flow. So having stable income streams, try to diversify clients to avoid reliance on a single customer. Use tools like QuickBooks or other accounting softwares to track cash flow and forecast gaps. Maintain a debt service coverage ratio or DSCR of 1.25 plus. And then try to provide collateral and personal guarantees if needed. Secure loans with assets, offer real estate, equipment, inventory, or anything else for better terms. Build strong banking relationships. Avoid mixing personal and business finances. Show consistent deposits. So lenders review bank statements. Regular revenue deposits improve trust. And establish a business line of credit before you need it for emergencies. So before making a loan application, prepare a solid package in terms of required documents. So business plan for startup growth loans, 2 to 3 years of financial statements, profit and loss statements, balance sheet, income statement, cash flow, tax returns, debt schedules, existing loans or payments, and then also try to explain your needs clearly. So lenders favor borrowers who articulate how funds will be used, for example, for expansion purposes or for buying equipment. So the final thought is lenders favor businesses that look low risk, organized, and financially disciplined. By focusing on these areas, you will improve approval odds and secure better terms.